You know, there's an old saying in investing that I've lived by for over 70 years. Be fearful when others are greedy and greedy when others are fearful. It sounds simple, doesn't it? But I can tell you from decades of experience that it's one of the hardest principles to follow in practice. When everyone around you is panicking and selling, when the news is filled with doom and gloom, when your friends and neighbors are convinced the world is ending, that's precisely when the greatest opportunities emerge. And that's what I want to talk with you about today, what I'm buying while everyone else is selling. Let me start by taking you back to a moment that taught me this lesson in a way I'll never forget. It was October of 1987. I was already well established by then, running Berkshire Hathaway for over 2 decades. On October 19th, the stock market crashed. And I mean crashed. The Dow Jones fell 22% in a single day. It was the largest one-day percentage decline in stock market history. People were terrified. They thought it was 1929 all over again, that we were heading into another Great Depression. I remember sitting in my office in Omaha, watching the chaos unfold. The phones were ringing off the hook. People wanted to know what I was doing, whether they should sell everything, whether this was the end. And you know what I did? I started buying, not because I knew the crash was over, not because I had some crystal ball that told me everything would be fine, but because I understood something fundamental. When you get the chance to buy wonderful businesses at fire sale prices, you buy. You don't worry about catching a falling knife. You don't worry about whether the market will go down another 10 or 20%. You focus on the underlying value of what you're buying. That experience reinforced a principle that has guided every major investment decision I've made since. The best time to invest is almost always when things look terrible. It's when pessimism is at its peak, when fear dominates the headlines, when everyone is convinced that this time is different and things will never recover. That's when you find bargains. That's when you can buy dollars for 50 cents. Now, as I speak to you today in 2026, we're in an interesting moment. The market has been volatile. We've seen corrections in various sectors. Interest rates have been uncertain. Geopolitical tensions are elevated. Some industries are struggling with change and disruption. And yes, a lot of people are selling. They're worried about recession, about inflation, about interest rates, about artificial intelligence disrupting jobs, about conflicts around the world. I understand those concerns. They're real. But here's what I know. The American economy is incredibly resilient. It has weathered far worse storms than what we're facing now. It's survived the Great Depression, multiple world wars, the stagflation of the 70s, the dot-com crash, the financial crisis of 2008, and a global pandemic. Through it all, businesses adapted, innovated, and thrived. The economy grew, standards of living improved, and investors who stayed the course and bought during the scary times were richly rewarded. So what am I buying right now while others are selling? Let me walk you through my thinking, sector by sector, opportunity by opportunity. I'll explain not just what I'm buying, but why. I'll share the framework I use to identify value when everyone else sees only risk. First, I'm looking very carefully at energy companies. Now, I know energy has been out of favor with many investors. There's been tremendous focus on renewable energy and electric vehicles. People talk about the end of oil and gas, about stranded assets, about companies that will be obsolete in 10 or 20 years. And yes, the long-term trend is toward cleaner energy. I believe that. And it's important. But here's the thing. The world still runs on oil and gas, and it will for decades to come. We use oil for transportation, for chemicals, for plastics, for countless industrial processes. We use natural gas for electricity generation, for heating, for manufacturing. The International Energy Agency projects that global oil demand will continue growing until at least 2030, possibly longer. Even as we transition to cleaner energy, we'll need these fossil fuels. What's happened is that many energy companies have been starved of capital. Environmental concerns and investor pressure have made it difficult for them to invest in new production, but demand hasn't disappeared. It's actually growing in many parts of the world. That's creating a supply-demand imbalance that favors producers. These companies are generating enormous free cash flow. They're paying down debt. They're returning cash to shareholders through dividends and buybacks. I'm particularly interested in integrated oil companies, the ones that have upstream production, downstream refining, and chemical operations. These businesses are diversified. They can make money in different parts of the cycle. And right now, many of them are trading at very reasonable valuations. When I see a company generating 10 or 15% free cash flow yields with a strong balance sheet and a sustainable competitive advantage, I pay attention. That's especially true when everyone else is avoiding the sector. Berkshire's had a position in Chevron for several years now, and I think it remains attractive. This is a company that will be producing energy for decades. It's developing natural gas projects that will be crucial for the energy transition. It's investing in renewable fuels and carbon capture. It's not standing still, but it's also generating billions in cash from its traditional operations, and much of that cash is being returned to shareholders. When others are selling these stocks because they're not fashionable, I'm happy to be a buyer. Second, I'm very interested in certain financial companies beyond the banks I've already discussed. Specifically, I'm looking at insurance companies and financial services businesses that have been sold off due to fears about the economic cycle. Insurance is a business I know exceptionally well. Berkshire's insurance operations have been the foundation of our success for decades. I understand how these businesses work, what makes them valuable, and what can go wrong. Right now, we're seeing a hard market in many insurance lines. That means premiums are rising and terms are tightening. After years of soft market conditions where insurers were competing fiercely and underpricing risk, the cycle has turned. Insurance companies are getting paid better for the risks they're taking. That's a very good environment for well-managed insurers. I'm also seeing value in some property and casualty insurers that have been beaten down by concerns about climate-related losses or litigation risks. Yes, these are real concerns. Climate change is increasing the frequency and severity of certain disasters. Litigation in areas like social inflation is a challenge. But the best insurance companies price for these risks. They adjust their underwriting, they manage their exposure, and they still make money over time. What makes insurance so attractive as a business is the float. Insurance companies collect premiums up front and pay claims later. In the meantime, they get to invest that money. If they underwrite carefully and earn a profit on their policies, they essentially get paid to hold other people's money and invest it. That's a wonderful business model. And when you can buy quality insurance companies at reasonable prices during periods when investors are worried about the sector, you should do it. Third, I'm looking at consumer companies that have been sold off despite having strong brands and dominant market positions. The consumer sector has been under pressure for various reasons. Rising interest rates have worried people about consumer spending. There's been concern about whether consumers can handle higher prices. Some specific categories have faced challenges from changing consumer preferences or new competition. But here's what I focus on. Brands that people will still want in 10 or 20 years. Products that have pricing power, companies with loyal customers and strong distribution networks. When you find these businesses trading at discounts because of temporary concerns, that's opportunity. I think about companies in food and beverage, in household products, in personal care. These are businesses selling things people use every day. They're not exciting. They don't have cutting-edge technology or explosive growth potential, but they're reliable. They generate cash. They pay dividends. And the best ones can raise prices over time to offset inflation and protect their margins. Coca-Cola has been one of Berkshire's greatest investments ever. We've held it for decades through all kinds of economic conditions and changing consumer trends. Why? Because people around the world still want Coca-Cola products. The brand is incredibly powerful. The distribution network is unmatched. The economics of the business are excellent. When I see similar characteristics in other consumer companies that have been sold off, I take notice. I'm also interested in companies that have successfully adapted to e-commerce and direct-to-consumer trends. The retail landscape has changed dramatically, And some traditional consumer companies have struggled, but others have figured it out. They built strong online presences while maintaining their physical retail partnerships. They've used data and technology to better understand their customers. They've defended their brands and even strengthened them. These adaptable companies trading at reasonable prices are attractive to me. Fourth, I'm looking very carefully at certain industrial and manufacturing companies. Manufacturing isn't glamorous. It doesn't get the attention that technology or biotechnology gets. But manufacturing is essential to the economy. We need companies that make things, that build infrastructure, that produce the components and equipment that keep the world running. Many industrial companies have been sold off because of concerns about economic growth slowing, about supply chain challenges, about rising input costs. These are legitimate concerns in the short term. But the best industrial companies have pricing power. They can pass through higher costs to customers. They have strong market positions in their niches. They have order backlogs that provide revenue visibility. I'm particularly interested in companies tied to infrastructure spending. Governments around the world, including the United States, are investing heavily in infrastructure. We're rebuilding roads and bridges, expanding electrical grids, upgrading water systems, building out broadband networks. This creates sustained demand for all kinds of industrial products and services. Companies positioned to benefit from these trends are worth examining closely. I also like industrial companies with strong aftermarket or service businesses. These are companies that don't just sell a product once, but generate recurring revenue from maintaining, servicing, and supplying that product over its lifetime. That recurring revenue is extremely valuable. It's predictable, it's high margin, and it creates customer stickiness. When you can buy a company with these characteristics at a reasonable price, you're getting something special. Fifth, let me talk about something that might surprise people. I'm looking at certain technology companies. Now, I know I have a reputation for avoiding technology. For many years, that was true. I stuck to businesses I understood, and I didn't feel I could predict which technology companies would succeed or fail. That caution served me well during the dot-com bubble. But technology has matured. Some technology companies have become the dominant businesses of our era. They have massive competitive advantages. They generate enormous cash flows, and they're trading at reasonable valuations. I'm not talking about speculative startups or companies with no profits. I'm talking about established technology giants that would be expensive at any price in a normal market, but have been sold off due to various concerns. Apple has been one of Berkshire's largest positions, and it illustrates my thinking. Apple isn't really a technology company in the traditional sense. It's a consumer products company that happens to use advanced technology. It has an incredibly loyal customer base. Its ecosystem of products and services creates powerful lock-in effects. It generates massive amounts of cash that it returns to shareholders. The business has durability and predictability that I can understand and value. I'm also interested in certain software companies, particularly those with subscription-based business models. These companies have customers who pay recurring fees for essential software. Once a business integrates mission-critical software into its operations, switching costs are high. That creates stable, predictable revenue streams. When these companies trade at reasonable multiples of their free cash flow, they become interesting investments. The key is focusing on technology companies with sustainable competitive advantages and rational valuations. I'm not interested in paying sky-high multiples for growth that may or may not materialize. But when solid, cash-generating technology businesses sell off because growth has slowed or because investors are rotating out of the sector, I'm willing to step in. Sixth, I want to talk about healthcare because it's an area where I see significant opportunity. Healthcare has been complicated and contentious. There have been regulatory concerns, pricing pressures, political debates about drug costs and insurance coverage. These issues have created volatility and uncertainty in healthcare stocks. But here's the fundamental reality. Healthcare demand is non-discretionary and growing. As populations age, as medical technology advances, as living standards improve in developing countries, healthcare spending increases. It's not optional. People need medical care, prescription drugs, medical devices, and health insurance, regardless of what's happening in the economy. I'm interested in pharmaceutical companies with strong drug pipelines and diversified portfolios. Yes, drug pricing is under pressure in some areas. Yes, patent cliffs create challenges when blockbuster drugs lose exclusivity. But the best pharmaceutical companies keep innovating. They develop new treatments for diseases that have no good options. They build portfolios that can weather individual product challenges. And they generate enormous cash flows that support dividends in research and development. Medical device companies also interest me, particularly those with products used in high-volume procedures. These aren't devices for experimental treatments. They're devices for things like heart procedures, orthopedic surgeries, diabetes management, diagnostic imaging. As populations age, demand for these procedures grows. The best device companies have protected intellectual property, strong relationships with physicians, and regulatory expertise that creates barriers to entry. Healthcare services companies, particularly those in pharmacy benefit management, healthcare IT, or hospital operations, also merit attention. These businesses benefit from the complexity of the American healthcare system. They provide essential services that help manage costs, improve efficiency, or connect different parts of the system. When these companies trade at discounts due to sector concerns, they're worth investigating. Now, let me talk about my approach more broadly, because it's not just about specific sectors or companies. It's about having a framework, a way of thinking about value that doesn't change based on market sentiment. First, I always start with the question, do I understand this business? Can I predict with reasonable confidence what it will look like in 10 or 20 years? If I can't answer yes to those questions, I don't invest, no matter how cheap it looks or how much everyone else is selling. Staying within your circle of competence is crucial. Second, I look for durable competitive advantages, what I call moats. These are the things that protect a business from competition and allow it to earn above average returns on capital over time. Moats can come from brand strength, from network effects, from economies of scale, from patents and intellectual property, from high customer switching costs, from regulatory advantages. The wider the moat, the more valuable the business. Third, I insist on good management. I want to invest alongside people who think like owners, who allocate capital wisely, who are honest and competent. Management can make or break a business. A great business with poor management will eventually disappoint. A good business with excellent management can create enormous value. I look for managers who are rational, who are focused on long-term value creation rather than short-term stock price movements, and who treat shareholders fairly. Fourth, I focus on price. This might sound obvious, but it's remarkable how often investors forget about price. They fall in love with a business or a story and pay any price to own it. I don't do that. I want to buy businesses for less than they're worth, ideally, significantly less. That margin of safety protects me if my analysis is wrong or if unexpected things happen. It also provides upside as the market eventually recognizes the value I saw. When you combine these principles with patience and the courage to act when others are fearful, you create a powerful investment approach. It's not complicated, but it's also not easy. It requires discipline. It requires the emotional fortitude to buy when everything feels scary and uncertain. It requires confidence in your analysis and the patience to let your thesis play out over time. Let me share another story that illustrates this. In 2008 and 2009, during the depths of the financial crisis, Berkshire made several significant investments. We invested in Goldman Sachs, in General Electric, in various other companies that desperately needed capital. The deals we struck were favorable to Berkshire because we were providing capital when almost no one else would. People thought I was crazy. They said the financial system was collapsing, that these companies might fail, that I was catching falling knives. But I saw something different. I saw that the U.S. government would not allow the financial system to collapse. I saw that these were fundamentally sound businesses facing temporary liquidity crises. I saw that we were getting paid extremely well for the risk we were taking, and I was right. Those investments generated enormous returns for Berkshire. But more importantly, they reinforced my belief that the best opportunities come during the worst times. That's the mindset I have today. Yes, There are concerns in the market. There are always concerns. But the fundamentals of capitalism haven't changed. Good businesses run by good people serving genuine customer needs will create value over time. When you can buy those businesses at reasonable prices during periods of pessimism, you should do it. I also want to address something important, what I'm not buying. I'm not buying speculative stocks with no earnings and blue sky promises. I'm not buying cryptocurrencies or non-fungible tokens or whatever the latest fad is. I'm not buying companies just because they're working on artificial intelligence or quantum computing or whatever buzzword is popular. I'm not buying businesses I don't understand or companies with questionable management or situations where I'm depending on a greater fool to pay a higher price later. My approach is boringly consistent. Find good businesses, understand them thoroughly, buy them at reasonable prices, and hold them for the long term. It's not exciting. It won't make for good cocktail party conversation, but it works. It has worked for me for over 70 years, through every kind of market condition imaginable. Let me also talk about what I'm doing with Berkshire's cash. We've been criticized at times for holding large cash positions. People say we're not putting our money to work, that we're wasting the opportunity to earn returns. But I view cash differently. Cash is optionality. Cash gives you the ability to act when opportunities arise. During normal times, when valuations are full and everyone is optimistic, there aren't many compelling investment opportunities. But when markets dislocate, when fear dominates, when quality businesses sell off for reasons unrelated to their fundamental value, that's when cash becomes incredibly valuable. Right now, we're deploying some of that cash into the opportunities I've described. We're being selective, focusing on businesses we understand and can hold for the long term. We're not rushing, we're not forcing anything, but we're finding opportunities and we're taking advantage of them while others are selling. I'm also buying back Berkshire shares when they trade below our estimate of intrinsic value. This is something we've been doing increasingly in recent years. When our own stock is undervalued, buying it back is one of the best investments we can make. We're buying a diversified collection of wonderful businesses at a discount. We're increasing the ownership stake of our remaining shareholders, and we're doing it with cash that might otherwise sit idle or be invested in lower return opportunities. The key to successful investing during volatile times is perspective. You have to zoom out. You have to think about where things will be in 5 or 10 or 20 years, not where they'll be next week or next month. Short-term market movements are noise. They're driven by emotion, by technical factors, by headlines. Long-term value creation is driven by fundamental business performance. Think about someone who invested in the stock market in 2008, right before or during the financial crisis. They bought when everyone was terrified, when the news was uniformly terrible, when it felt like the world was ending. How did they do? Extraordinarily well. The market has multiplied several times over since then. Dividends have been paid. Good businesses have compounded their value. That investor was rewarded handsomely for their courage and their long-term perspective. That's the opportunity I see today, not in the market as a whole perhaps, but in specific sectors and companies that have been sold off excessively. Energy companies generating huge cash flows, trading at single-digit earnings multiples. Financial companies with fortress balance sheets selling below book value. Consumer brands with decades of history trading as if they're going out of business. Industrial companies benefiting from infrastructure spending being priced for recession. These are the kinds of opportunities that emerge when pessimism dominates. I want to emphasize something else. I'm not trying to time the market. I don't know whether stocks will be higher or lower in 6 months. I don't know when the current period of volatility will end. I don't have any special insight into what the Federal Reserve will do or how the economy will perform in the near term. And frankly, I don't care much about any of that. But what I care about is buying good businesses at prices that make sense relative to their long-term earning power. If I do that consistently over time, the results will take care of themselves. The market will eventually recognize value. Maybe it takes 6 months, maybe 2 years, maybe 5 years. The timing doesn't matter much if you bought well and you're patient. This is very different from how many people approach investing. They try to predict market movements. They look at charts and technical indicators. They watch financial television and react to every piece of news. They trade in and out constantly, trying to catch every move. That's not investing, that's speculation. And over the long term, it's a losing game for most people who try it. My approach is simple. I look for businesses I want to own for a decade or longer. I value them conservatively. I buy them when they're available at attractive prices. And then I let time and the power of compounding do their work. It's not exciting, but it's effective. As I think about what I'm buying today, I'm also thinking about what Berkshire will look like in 10 or 20 years. These investments we're making now, they're not just about generating returns next year or the year after. They're about building long-term value for our shareholders. They're about positioning Berkshire to continue compounding value for decades to come. That long-term orientation is increasingly rare in today's markets. So many investors are focused on quarterly earnings, on short-term stock price movements, on beating some benchmark over the next 12 months. That short-term focus creates opportunities for those of us who think differently. When everyone is selling because of near-term concerns, we can buy businesses that will create value for years to come. Let me close with this thought. The stock market is a device for transferring money from the impatient to the patient. I believe that my entire life, and nothing I've seen has changed my mind. The people who sell during scary times, who panic when markets fall, who can't stomach volatility, they're transferring wealth to the people who stay calm, who think long term, who have the courage to buy when others are fearful. Right now, while many people are selling, I'm buying. I'm buying energy companies that will fuel the world for decades. I'm buying financial companies with strong competitive positions. I'm buying consumer brands that people will still want in 20 years. I'm buying industrial companies building the infrastructure tomorrow. I'm buying select technology companies with durable advantages. I'm buying healthcare companies serving growing medical needs. I'm doing this not because I know what will happen tomorrow or next month, but because I know what will happen over the long term. These businesses will continue operating. They'll serve their customers. They'll generate cash flows. They'll create value. And eventually, the market will recognize that value. When it does, the returns will be excellent for those who had the courage and the patience to buy when everyone else was selling. That's what I'm doing today, and that's what I've always done. It's worked pretty well so far. Now, let me get more specific about some of the characteristics I look for when I'm buying during periods of market stress. It's not enough to just say, I want good businesses at good prices. You need a framework for identifying what makes a business truly good and what constitutes a good price. When I'm evaluating a business, I always start with the same question. What is this company's competitive position 10 years from now? Not next quarter, not year, but a decade from now. Will it still be relevant? Will it still have pricing power? Will it still be earning attractive returns on capital? If I can't answer yes with reasonable confidence, I move on. There are thousands of publicly traded companies. I don't need to understand all of them. I just need to find a handful that I understand deeply and that are available at sensible prices. Let me talk about some specific examples of what I mean by durable competitive advantages. Take a company like Coca-Cola, which I mentioned earlier. What makes Coca-Cola's advantage durable? It's not the secret formula, though that's part of it. It's the brand that has been built over more than a century. It's the global distribution system that reaches virtually every corner of the world. It's the shelf space in millions of retail outlets. It's the emotional connection consumers have with the product. Could a competitor replicate all of that? Theoretically, yes, but practically, it would take decades and billions of dollars, and even then, success wouldn't be guaranteed. That's a durable competitive advantage. That's a moat. And when you can buy a business like that at a reasonable price during a period when consumer stocks are out of favor, you should do it. Or consider a company in the industrial sector, something that makes specialized equipment for a specific industry. Maybe they make valves for oil refineries or sensors for chemical plants or filtration systems for water treatment facilities. If they're the dominant player in their niche, if their products meet exacting specifications and have long approval cycles, if their customer switching costs are high because the products are integrated into larger systems. That's a competitive advantage. These aren't exciting businesses. You won't read about them in the business press, but they're exactly the kind of businesses that can compound value over decades. The company doesn't need to grow rapidly. It just needs to maintain its position, serve its customers well, and generate steady cash flows. If I can buy that kind of business at 8 or 10 times earnings while everyone is worried about industrial recession, I'm very interested. I also look carefully at capital allocation. How does management deploy the cash the business generates? This is one of the most important determinants of long-term shareholder returns, and it's something many investors overlook. A business can earn great returns on its existing operations, but if management wastes the cash flow on overpriced acquisitions, excessive capital spending, or ill-conceived diversification efforts, shareholders won't benefit. The best capital allocators are disciplined and opportunistic. They invest in their core business when returns are attractive. They return cash to shareholders through dividends or buybacks when investment opportunities are limited. They make acquisitions only when they can buy businesses at sensible prices that fit strategically. They avoid empire building. They think like owners, not managers, trying to maximize the size of their empire. I've seen many examples over the years of good businesses with poor capital allocation destroying shareholder value. And I've seen examples of decent businesses with exceptional capital allocation creating enormous value. It matters tremendously. When I'm evaluating a potential investment, I spend a lot of time studying what management has done with cash in the past. That track record tells you a lot about how they'll behave in the future. Let me also talk about something that's become increasingly important, a company's culture and values. Now, I'm not talking about corporate social responsibility statements or diversity reports, though those can be indicators. I'm talking about the actual values that guide how a company operates. Does it treat customers fairly? Does it treat employees well? Does it deal honestly with suppliers and partners? Does it take a long-term view? Or is everything driven by next quarter's earnings? These cultural factors might seem soft, but they have hard consequences. Companies with strong cultures tend to attract and retain better employees. They tend to have better relationships with customers and suppliers. They tend to make better decisions because they're not constantly cutting corners or optimizing for short-term metrics at the expense of long-term value, and they tend to avoid the kind of scandals and problems that can destroy years of value creation overnight. When I'm buying during periods of market stress, I'm often buying from sellers who are focused on near-term concerns. They're worried about next quarter's earnings, about whether the stock will bounce back quickly, about what analysts are saying. They're not thinking about where the business will be in 10 years. That's their loss and my gain. I'm happy to buy from short-term thinkers and hold for the long term. I want to share another lesson I've learned over the decades: the importance of acting decisively when opportunity presents itself. When you see a good business at a good price, you need to act. You can't wait for more information, for greater certainty, for the perfect moment. By the time everything is clear and comfortable, the price will have adjusted and the opportunity will be gone. This doesn't mean being reckless. You still need to do your homework to understand what you're buying, to have conviction in your analysis. But once you've done that work, you need to be willing to pull the trigger even when it feels uncomfortable. In fact, if it doesn't feel at least a little uncomfortable, you're probably not getting a great price. I remember during the financial crisis, I wrote an article for a newspaper with the headline about buying American stocks. This was in October of 2008, when the crisis was intensifying and many people were predicting the end of the financial system. I said in that piece that I was buying American stocks, and I meant it. Berkshire was deploying capital aggressively. Did I know the market had hit bottom? No. In fact, it went lower after that article was published. But I knew that businesses were being priced for catastrophe, and I knew that while the financial system faced serious challenges, it would survive. I knew that over time, American businesses would continue creating value. So I bought, and those investments worked out very well. That's the mindset you need when you're buying while others are selling. You need to be comfortable with uncertainty. You need to accept that you might not catch the absolute bottom. You need to focus on value, not on timing. If you buy something worth $1 for 50 cents, it doesn't matter much whether you could have bought it for 45 cents if you'd waited another month. Let me talk about another sector where I'm finding opportunity: real estate related businesses. Now, I don't mean speculating on property values or buying real estate investment trusts based on their dividend yields. I mean businesses that benefit from real estate activity or that own productive real estate assets as part of their operations. For example, I'm interested in companies that make building products, things like insulation, roofing materials, windows, heating, and cooling systems. Housing starts have been volatile, and concerns about affordability and interest rates have weighed on these stocks. But the fundamental need for housing hasn't changed. America has underbuilt housing for years. We need more homes, more apartments, more senior living facilities. That creates sustained demand for building products. The best building product companies have strong brands that contractors and builders trust. They have technical advantages in their products. They have distribution networks that are difficult to replicate, and they generate attractive returns on capital. When these companies sell off because housing data is weak for a few months, that creates opportunity. I'm also interested in logistics and industrial real estate companies. The growth of online shopping has created massive demand for warehouse and distribution space. Every package ordered online has to be stored somewhere and shipped from somewhere. That requires modern, well-located logistics facilities. Companies that own or operate these facilities are benefiting from a long-term structural trend. When they sell off due to concerns about interest rates or economic growth, I pay attention. Let me address something that I know concerns many people: artificial intelligence and its impact on businesses. There's tremendous hype around this technology right now. Every company is talking about how they're implementing it, how it will transform their business, how it will drive growth. Some of this is genuine, but much of it is marketing. My approach is pragmatic. I'm not trying to predict which companies will dominate or which technologies will win. I'm not investing in speculative startups. Instead, I'm thinking about how this technology will affect the businesses I already understand. Will it make these businesses more efficient? Will it help them serve customers better? Will it strengthen their competitive positions, or will it erode them? For many of the businesses I've discussed today, this new technology is more of an opportunity than a threat. A well-managed industrial company can use it to optimize its operations, to improve quality control, to better serve customers. An insurance company can use it to underwrite more accurately and process claims more efficiently. A bank can use it to detect fraud and personalize customer experiences. These applications strengthen existing businesses rather than disrupt them. What I avoid is businesses where new technology might fundamentally undermine their competitive position. If a company's moat is based purely on information advantages or on performing routine tasks, that might pose a threat. But if the moat is based on physical assets, on brand strength, on network effects, on customer relationships, on operational excellence, technology is more likely to be a tool these companies can use rather than a threat to their existence. I also want to talk about the importance of patience, because it's perhaps the most valuable trait an investor can have. When you buy while others are selling, you're often buying something that will take time to work out. The market doesn't immediately recognize that you got a good price. In fact, your investment might go down further before it goes up. But you need to be comfortable with that. I've held some investments for decades. Coca-Cola, American Express. These are positions we've held for 30 or 40 years. During that time, there have been periods when these stocks were out of favor, when people questioned whether they were still relevant, when the share prices stagnated or declined. But we held on because we understood the businesses, we knew they had durable competitive advantages, and we were confident in their long-term value creation. That patience has been rewarded many times over. Compare that to someone who trades in and out constantly, who sells when things get uncomfortable, who chases whatever's working at the moment. That person incurs transaction costs, pays taxes on gains, and misses the benefit of long-term compounding. They might have some winning trades, but over a lifetime of investing, they'll almost certainly underperform someone who buys good businesses and holds them patiently. This is why I always tell people that investing is simple but not easy. The principles are straightforward. Buy good businesses at reasonable prices and hold them for the long term. But executing those principles requires emotional discipline that most people don't have. It requires going against the crowd, being patient when others are impatient, being greedy when others are fearful. That's not easy, but it's how wealth is built. Let me share one more area where I'm finding opportunity. Companies going through temporary difficulties that are fixable. Every business faces challenges. Sometimes these challenges are permanent and reflect a deteriorating competitive position, but sometimes they're temporary and fixable, perhaps reflecting operational mistakes, integration issues from an acquisition, or a product recall. When a good business faces temporary fixable problems, its stock often gets punished as if the problems are permanent. Investors extrapolate the current difficulties indefinitely into the future. They assume the worst. That creates opportunity for those who can distinguish between temporary and permanent problems. The key is asking, is this a good business with good management facing a temporary setback, or is this a mediocre business in structural decline? If it's the former, the stock price decline creates opportunity. Management will fix the problems, the business will recover, and the stock will rebound. If it's the latter, you're trying to catch a falling knife, and you'll likely get hurt. I've made investments in companies facing temporary difficulties many times over the years. Sometimes it's been operational issues that new management is addressing. Sometimes it's been regulatory problems that will be resolved. Sometimes it's been a product issue that the company is fixing. If the underlying business is sound and the problems are being addressed competently, these situations can be very profitable. The advantage I have in these situations is patience and a long-term perspective. I'm not trying to flip the stock for a quick profit. I'm willing to hold while management works through the issues. That patience gives me the ability to invest in situations that short-term traders avoid. They need quick results. I can wait for the business to recover and reach its potential. As I think about everything I've shared with you today, the common thread is this: success in investing comes from having a sound framework and the discipline to stick to it regardless of market conditions. My framework hasn't changed in 70 years. Find good businesses with durable competitive advantages and capable management. Buy them at prices that provide a margin of safety. Hold them patiently and let the power of compounding work. It's simple, but it works. When others are selling, when fear dominates, when pessimism is pervasive, that's when this framework leads you to opportunity. That's when you find the bargains. That's when you can buy businesses for less than they're worth, and that's exactly what I'm doing today. I'm buying while others are selling, confident that over time, value will be recognized and patience will be rewarded. It's what I've always done, and it's what I'll continue doing for as long as I'm able. The opportunities are there for those willing to see them and brave enough to act.